US inflation behaves and supports rate cuts in the third quarter, and attention now turns to the US jobs market. New Zealand consumer confidence improves, but cautiously, and the final pieces of data are due ahead of the RBA's will they or won't they rate call next week. That's coming up in our 5 Things in 5 Minutes on Monday, June the 30th. And then in our deep dive interview, ANZ Head of Australian Economics, Adam Boyton, outlines ANZ Research's latest macroeconomic forecasts and the task ahead for the Reserve Bank of Australia.
How much easing do we need to get growth back to trend without overdoing it and getting growth above trend and the unemployment rate back below full employment and wages growth picking up? And so I think, there's a really challenging calibration there for the bank.
But first, in 5 and 5 with ANZ, I'm Bernard Hickey, and I thought I'd celebrate being back with that refreshed 5 and 5 theme track, which I hope you all enjoy. US stocks finished the week on a positive note after headline US PCE inflation rose in line with expectations to 2.3% annually in May. Core PCE came in slightly above forecast at 2.7% due to a monthly 0.2% increase. ANZ Head of G3 Economics Brian Martin says the data fits with the view that demand in the US economy is slowing.
When you break down into the data, inflation momentum still seems to be very moderate. Certainly, as far as May was concerned, there was no evidence of tariff effects in goods prices. Goods prices rose modestly and indeed softer than they did in April. I think the numbers are very consistent with the view that inflation has improved, that if there is not a strong tariff effect over the summer, that the FOMC will be in a position to cut interest rates. Our view is that the rate cutting cycle will resume in September.
The S&P 500 closed up 0.5% on Friday at 6,173. The US 10-year Treasury yield rose 2.9 basis points to 4.274. Gold closed down 1.36% at $3,302 an ounce, while West Texas Intermediate futures closed the week at $65.52 a barrel. The US dollar index was up 0.26%, and the Aussie dollar will open the week at 65.31 US cents after a 0.2% fall on Friday, while the Kiwi opens at 60.57 US cents after falling just a tad on Friday. Number 2. Attention now turns to the health of the US labour market this week. Here's Brian again.
The labour market data for June will be released over the course of the next week across an array of indicators, including the ADP report, private payroll gains, and the most important one, the labour market report on Thursday. It's coming on Thursday because of the 4th of July holiday in the States on Friday. The consensus is for a rise of 120,000, down from 139,000. So that would indicate that the pace of hiring in the US is continuing to slow, in line with the softness we're seeing in demand.
Number 3. There are reports President Trump may opt for an early announcement of Fed Chair Jerome Powell's replacement. ANZ Group Chief Economist Richard Yetzinger says it's hard to know just how significant an early announcement would be, but that it could end up rattling investors.
There has been discussion previously from the administration about effectively having a shadow Fed chair, and I have shadow in inverted commas. This idea that you announce early and then the markets start to discount Powell and bring the shadow chair out of the shadows, if you like, and potentially give them a bit more weight. I think there is probably something to that, but maybe not in the way the administration might hope. There is a risk here that markets get nervous about whoever is announced and start to worry about their attachment to the Fed's 2% inflation target.
Number 4. ANZ Roy Morgan's New Zealand Consumer Confidence Survey out on Friday showed a rise of 6 points following a fall in May. It remains below its long-term average. ANZ New Zealand Chief Economist Sharon Zollner says that despite that rise, expectations of negative economic times over the next year will weigh on spending.
Another factor that might be weighing on people's minds is that their expectations of inflation are extremely high. 4.9%, that's a 2-year high. Now, actually, 4.9 isn't far off 4.4, which is actually the current rate of food price inflation, but it is well above what we're expecting CPI inflation to be, and also well above what firms are thinking wage settlements are going to be. So I think it implies that the perceptions of real wage growth are going to be really quite grim, much worse than our expectations of actual real wage growth. If people feel like they're going backwards, that will make them less likely to spend.
Number 5. In Australia this week, May data will come out for private credit, building approvals, retail sales, the trade balance, and household spending. Richard says the RBA will be looking at every little piece as it weighs up whether to hold or cut rates again on July the 8th.
I think every piece of information for the RBA at the moment is important. The last monthly inflation number was a bit softer, but we still think the quarterly number is likely to be in line or even potentially a little bit stronger than their current set of forecasts. Also, the labour market seems to be running a little bit more strongly than their current set of forecasts. So while the numbers this week are not critical, I think this is a pretty finely balanced call for July. They'll be important.
Richard Getzinger there. Now, in our deep dive interview, ANZ Head of Australian Economics, Adam Boyton, discusses ANZ Research's latest updated forecast for the Australian economy, ahead of the RBA's July rate decision.
It looks like some of the more extreme downside scenarios for the global economy are less likely versus where, say, things were a few months ago. Indeed, we released our most recent ANZ Research quarterly last week, where we made the point that a serious downturn remains a low probability. So those tail risks, I guess, are a little less now for the global economy than they were, say, 6 or 8 weeks ago.
So domestically, we had that soft GDP print in Australia. Have you made any changes to your macro forecasts for the rest of the year?
We've made a few tweaks. I'd call them tweaks rather than big shifts in view. For example, on GDP growth, we actually still expect the economy to grow by 2% this year, despite that soft Q1 GDP growth print. And that's because there's a little bit more monetary easing from the RBA, and also because some of those tail risks for the global economy, I guess, seem a little less likely. When we think about next year, we've got growth at 2.4%. That's a little faster than where we were previously, where we thought growth would be 2.2%. And we've taken our first look at 2027, where we expect GDP growth of 2.6%. To put all those numbers in some context, I guess you'd think that average or normal or trend growth in the Australian economy is about 2.5%. So growth a little below that this year, pretty much well around that next year, and the same in 2027.
So how do you see the labour market performing over the rest of the year?
The forward indicators of the labour market that we track tend to suggest that there'll only be a very slight drift higher in the unemployment rate. So we have the unemployment rate peaking, this is on a quarterly average basis, at 4.3% at the end of this year, sort of staying there for the early part of next. But as growth in the economy picks up, I wouldn't be surprised to see the unemployment rate then fall in the back half of 2026 and through 2027. But forward indicators of the labour market, look, they're certainly not collapsing. We saw a little bit of growth in the Bureau of Statistics job vacancies data that was released a few days ago. And so I think the most likely outcome for the unemployment rate is just a very small rise from here.
And what about CPI inflation? And how does that fit into your expectations for what the RBA will do in the next few months?
The way I'm thinking about inflation and the Reserve Bank is inflation isn't a barrier for the bank. That is, it looks like inflation is close enough to the RBA's target. And I think, you don't want to obsess too much about is it 2.6 or 2.7 or 2.5. Each of those numbers is close enough to 2.5 for inflation not to be a huge consideration for the Reserve Bank when it's easing. I think the issue for the Reserve Bank is this is an easing cycle that has started and is being conducted with not that much spare capacity in the economy. It's unusual to, I guess, end a tightening cycle and move into an easing cycle with an unemployment rate sitting around 4.1%. And so I think for the bank, the issue for them is not so much what's the fine detail on CPI, but how much easing do we need to get growth back to trend without overdoing it and getting growth above trend and the unemployment rate back below full employment and wages growth picking up. And so I think, there's a really challenging calibration there for the bank. But I think the challenge on the calibration is just as much, if not more, on judging activity and where that goes as it is on inflation.
Adam Boyton there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, June the 30th. Catch you tomorrow with the first of 2 deep dive interviews into Australia's First Nations economy. It's great to be back. And thanks so much to Alex Tarrant for filling in over the last month. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.